Paul, you are live.
Hi everyone, I'm Paul Orfanos, National Community Engagement Manager at Delphi Bank, which is a division of the Bendigo Adelaide Bank. And on behalf of Jim Saris, our General Manager, and all our staff, I'd like to welcome you to today's special presentation, Australia, Greece, the European Union, an Economic Overview, which is brought to you in conjunction with the Greek Community of Melbourne as part of their very successful lecture series. Now, I'd like to take this opportunity to congratulate the Greek community, its president, Bill Papaflessas, board in particular, Nick Dallas, for providing a platform for these lectures, which have provided, I'd say, an opportunity for all of us to hear topics of interest discussed by knowledgeable speakers. And just some of the news now that's hot off the press, that the lecture series new program has been released this week, and it's featured on the Greek Community of Melbourne website. So it's on right now for all the lectures for next year. We're certainly proud at Delphi Bank of our association with the Greek community through the years. And it's worth noting that we've been involved as sponsor of the Lonsdale Street Festival and the Greek Film Festival for over 20 years now. But before I introduce our guest speaker, I'd like to say that we at Delphi Bank are very happy that we've managed to build, I'd say, a profitable and a professional bank. But equally importantly, though, is that we've developed, I'd call, a sensitivity to our environment that's given us the ability to see banking through a community lens. And one of the traits of being able to see banking through this community lens is our ability to embrace the communities in which we operate. And this here event is a great example of this. Furthermore, we've also been able to position Delphi Bank in the market as an organisation with a social conscience. And one of the outcomes of this positioning is the support that we give to over 300 community groups and organisations, which shows our desire to help people connect in different ways by supporting initiatives that unite people through shared vision and interest. Now, on behalf of all of us at the Greek community and Delphi Bank, thanks for your interest in today's talk. It's my pleasure now to introduce today's speaker, David Robertson. David joined Bendigo Bank 19 years ago as Head of Financial Markets, and today is Head of Economic and Market Research for Bendigo Adelaide Bank. As mentioned earlier, Delphi Bank is a division of the Bendigo Adelaide Bank. David's regular economic updates are available on the bank's LinkedIn and YouTube sites, and I certainly encourage you to subscribe to those sites. David's banking career commenced in 1989 as a foreign exchange dealer, and since then has worked in senior treasury and financial markets roles for Colonial State Bank, First Chicago, and CBA. Beyond work, David is married with 3 children and enjoys family life, the outdoors, golf, and thoroughbred racing. And if David was here a couple of weeks ago, he may have given us some tips for the Melbourne Cup. A warm welcome to David, and over to you.
Thanks very much for that introduction, Paul. And look, it's great to be invited to be back for this forum to talk about the economic outlook and the markets locally and in Europe as we race towards 2021. I've got a feeling we're going to welcome 2021 with a great deal of joy and perhaps wave goodbye to 2020 without too much of a farewell. But good evening. It's a real pleasure to join you all, albeit virtually this year. Hopefully everything's a little more normal in a year's time and we can be in person in 12 months' time. But look, it's really good timing to talk about everything that's happening in the world after the Reserve Bank rate cut just a couple of weeks ago and the federal budget last month, and internationally with recent developments around COVID, both the vaccine and also rising case numbers around Europe and in North America in particular, and with a new US president-elect. So look, I'll share my screen now to run through some slides to outline our view of the world, and that will lead into Q&A. So I will run through these slides at a relatively quick pace, but just let me make sure I press the right button here. So hopefully the slides and the pictures are clear on your screen, and I can run through these and talk to our view of the world. But look, I mainly want to talk about the path out of recession, both locally and internationally, which I suspect will be a bit of a W shape, as the diagram shows, with propped up by a wide range of support measures. But look, I don't want to sugarcoat the reality that we've just been through the deepest global recession for about 90 years, and for Australia, the deepest contraction here in living memory. So it's been a very difficult time, in particular, very difficult for aged care and for a wide range of parts of the community. But having acknowledged that fact, there are some positives, I think, that shouldn't be overlooked. And a lot of that is around relativities for Australia's economy. And also there are some relativities that we need to consider on an international stage. So again, for context, we've had the recession. That was the first 6 months of the year. Now I think we need to think about what the long, slow path through recovery is likely to look like here and overseas. So the themes I wanted to explore, I'd like to start globally, look at some of the key nations around the world, look at the European Union and the Greek economy in particular. And then I'd like to come back to the Australian economy and talk about how the recovery is likely to unfold locally. Globally, I think there will be a reasonable amount of divergence driven by COVID-19, and really driven by how different countries have contained and suppressed the virus, and how effective policy measures have been. And then there's all the knock-on impacts through global supply chains around the world. Then I'd like to have a look at nationally, and we're going to see some divergence nationally as well, given the second wave in Victoria, and we're just starting to see a second wave in South Australia as well. But next year, despite those second waves, is going to be a year for the economy reopening, the unemployment rate stabilising, and economic growth starting to pick up. So we'll have a look at those effects, both at a national level and also on a state-by-state basis. And also, I do want to pick up the really important aspect of all of this, which is that, the economy here and overseas has needed support and has received it. And the cost of that support really has come via government debt. And in the case of Australia, that's relatively cheap government debt given the AAA credit rating. But in other places around the world, including in Europe, it's a little more complicated. And the fact that in Europe, member states rely on ECB, the European Central Bank, for funding and for debt. And then there's the whole overlay of the EU governance system. So that does complicate the outlook, especially for Southern Europe, which obviously has a larger dependence on international tourism, so arguably has been more exposed to the global pandemic. So they're the things I'd like to explore over the next 25 or 30 minutes before we move into Q&A. To get started though, globally, look, the unique aspect of 2020 obviously has been the pandemic, and just how infectious this version of coronavirus is than previous versions of coronavirus, which do actually come along relatively regularly. And you might recall back in 2003 with SARS, which was equally a concern back then, but was far less contagious than COVID-19. But this chart shows mortality rates, which is a little morbid, but that's the best way, I think, to show the impact and to differentiate between different parts of the world. And you can see that the mortality rate in Europe and North America, and increasingly in South America as well, is much higher than in Asia, which is where the virus started, and also in particular than Oceania. And so, it's been a real test of leadership. Countries that were decisive and effective with policy, with health policy, fiscal support, and its practical application, have been less impacted than those countries that were slower to respond, or really slower to get people on board with it all. Here in Australia, I'm full of praise for our policy response, even with the second wave that we've seen in Victoria. And I'd say that because the per capita numbers are so low, meaning Oceania, which is mainly Australia, New Zealand, Fiji, and so on, barely shows on this chart. And it's a similar pictorial if you looked at COVID infection numbers as opposed to the mortality rate. But look, again, beyond the human tragedy, including in aged care, getting the health crisis under control is the key to economic recovery and to limiting the financial damage. And that's really the key to quickly reopening borders. And so there is a link between managing the health crisis and the economic consequences. And I think this second chart here on the bottom right there shows it very well. It was something that the OECD put together 6 months ago when they were forecasting what COVID-19 might mean for Australia. And what they suggested was that it would be a V-shaped recovery, albeit a deep V in the event of a single hit, but a W shape if we got a second wave. And of course, that's what ended up happening. So, I think you can apply that principle to most countries around the world. And we're not just seeing second waves now, we're actually seeing third waves in some cases. So let's have a quick look at that. Look, the country that has bounced back most aggressively has been China, who admittedly did have a 10% hit to GDP, but are actually now at higher levels of economic activity than pre-pandemic. This is a chart that ranks from least impacted to most impacted, how all countries, or how countries that were of comparable economies to Australia and to a number of European locations ranked. And you can see least impacted: Taiwan, Vietnam, South Korea, Hong Kong, Norway. So, they are the countries that had a smaller peak to trough contraction than Australia did. And as it happens, a lot of them are Australia's trade partners. Scandinavia was the part of Europe that seemed to cope best with COVID-19. So the red discs in this chart show the peak to trough fall in GDP, and then the blue bar chart shows how it's recovered through to the end of September. At the other end of the scale, well, actually most impacted peak to trough was India, although their recovery has been actually relatively sharp. But look at Spain and the UK, a 22% hit to their GDP, and they're now down 10%. And then even working your way through the list, you can see New Zealand was quite hard hit, although they had a more stringent shutdown and their recovery has been stronger. But Canada, the US, much deeper recession than we experienced here in Australia. So it's an interesting comparison. It's still all about COVID-19. For the countries that have got the health crisis under control, they're the ones that are going to be able to recover in a more sustainable manner. And the ones that don't have it under control yet, I think, are really going to struggle, even in the post-pandemic economy. So just to explain that, there are a few different stages to this. Obviously, we've had the lockdowns to cope with the health crisis. Then you reopen to what I would call a COVID-safe economy, and that's pretty much where Australia is today and many parts of Asia. And then the next step after that is going to be moving to a post-pandemic economy once we have a viable vaccine. And again, that news has been very promising in terms of the vaccine trials over the last few weeks. But if you look at this chart, many parts of Western Europe, including UK, France, Spain, and even parts of Scandinavia, are still seeing high, increases in case numbers. And you see that in the United States as well. And so it's going to be really difficult for those countries to join, for example, travel bubbles until they've got the pandemic under control. Down on the bottom part of that scale, these are less impacted countries, and you can see Australia there with Japan and other parts of Asia. So look, it's been a really challenging period. Just for the USA, a bit of a harmless quip there with the change of presidency. And look, I think it is going to be important to see how the new administration in the US tackle global issues, keeping in mind that Biden doesn't actually get the keys to the White House till January the 20th, and the incumbent doesn't seem to be in a rush to hand over those keys. But assuming that process plays out smoothly, as it should, I do think that the US, their focus will be more on a multilateral approach to dealing with global issues like trade, like pandemics, and also like climate. Overall, I think that this multilateral approach will be helpful for global trade. But that doesn't mean that the US-China trade disputes will go away in a hurry. It's going to be a really interesting dynamic to observe. And maybe there'll be more tensions around technology than around trade in the years ahead, given Biden's focus. So look, that's overseas. Let's look at a couple of other aspects of all of this, in particular for Europe, before I come back to Australia. And this is a chart which shows the mobility impact of second and third lockdowns. And you can see some parts of Europe which are well back down into lockdowns, whether or not that's in Ireland or Belgium or France. And that's, you know, a similar situation in the United Kingdom, who are about to go through a significant lockdown as well. But then countries like New Zealand and Australia had the sharp lockdowns and are really reopening. So as a result of all of this, you know, countries that are more dependent on international tourism have done it toughest. If we contrast Europe and the UK, who are no longer in the EU, thanks to Brexit, with, say, the US and Japan, you can see that the services sector had been bouncing back in red there, but I think that's going to be really difficult to continue with the next wave of lockdowns. And in the case of manufacturing, the bounce back has been relatively firm through the surveys there. But I do have to admit that I'm pessimistic about the recovery for Europe and for the UK due to the what's happening with COVID-19 and the next range of lockdowns, although there will be wide variations country by country. I'd like to move more specifically to the Greek economy, and I just want to reference some data from the IMF. This is an image from the IMF website where there's some rich data about their forecasts. But look, it has been a really sad outcome that, as we were discussing a year ago, just when the Greek economy had got back to its highest level of GDP growth since the GFC, falling unemployment and a balanced budget, bonds were trading at levels akin to the rest of Europe. All of a sudden, the pandemic was a cruel blow, given the dependence on tourism, international tourism in particular. The recession, as the red line shows for the Greek economy, is around about the same as we saw during the GFC and with the European sovereign debt crisis. The red dots here show the recovery that's expected over the next couple of years. So it actually hasn't been as deep a recession as was initially feared. But, you know, unemployment is at 17%. Youth unemployment is around double that rate. So it is a very difficult situation. Again, you can see the recovery for GDP that's forecast back to about 4% over the next 2 years. For inflation, which was dangerously high in the late 80s, it looks fairly benign and heading back to sort of normal levels there. But look, just to go into a little bit more detail before I come back to Australia, and apologies, these numbers are going to be nigh on impossible to read on a computer screen, but for anyone who would like a copy of the slides, they're freely available. So some of this data, it probably needs a little bit more analysis over a cup of tea or maybe something stronger. But I've just picked out a couple of lines there comparing Germany and Greece, Germany being the largest economy in Europe and so quite influential. You can see that at the end of 2019, the Greek economy was expanding by pretty close to 2%. For Germany, it was 0.6. Then we had the recession, and so it's going to be a contraction of just shy of 10% for Greece for 2020. But then if you look at the recovery through 2021, both those recovery rates tick over 4%. And then we look to 2022, where the Greek economy will be back to outperforming as it was at the end of 2019, really, which I think is going to be playing catch up for those years of austerity and budget repair. And I do think that the post-pandemic economy, once we have a viable vaccine, which looks like it might only be 6 to 9 months away, will be one of stronger consumer spending, and really playing catch up for this year where there's been all the fiscal and monetary support. And I do think that that fiscal and monetary support globally and including through Europe with the ECB will stay in place longer than it probably should. Now, the next step beyond that might be a bit of a bubble, but let's just worry about the next couple of years. I do think those forecasts, despite the severity of the recession that we've just been through, do give some cautious optimism for once we get to the post-pandemic economy. But I've already explained that just this COVID-safe economy is going to be quite bumpy and uneven and very challenging. So that's just a few comments about Europe. Let me come back to Australia and nationally first. I just want to start with jobs. And actually, we got an update to the unemployment rate today. But this chart shows Australia's jobs numbers, total employment in purple, and I've contrasted it there with the United States in red. But with Australia, which I want to concentrate on now, using the right-hand scale, 13 million Australians with a job at the start of the year, a savage hit when that fell within 2 months down to 12.1 million from 13. So that was effectively over an 11% unemployment rate. But the recovery has been really strong since May. And so a couple of points I wanted to make about the jobs market at present. Firstly, that it was about an 8% hit to employment, about a 10% hit to total hours worked. But the low point for that cycle was early May, which is 6 months ago. The second point to make is that despite all of the policies that have been put in place nationally, and I think the National Cabinet has been very effective, but despite that, different sectors have been hit differently to vastly different degrees, and this applies to Australia as much as anywhere in the world. But you can see, just through to April, the gold discs there show the initial hit, a 35% fall in jobs for accommodation and food services. So obviously, hospitality, arts and rec, tourism did a lot worse than elsewhere. The gold dot is the initial hit, and then the blue bar shows the fall in total jobs through to mid-October. And you can just see how uneven the recession was and how uneven the recovery has been. And, conversely, the other end of the scale, some of the services sectors actually coped very well and have recovered completely. The third point to make around the jobs market has been how different the experience has been region by region, state by state, and even quite a bit of variance capital city versus regional Australia. So all states and territories were hit by about 9% initially. And so that's the blue disc there through to mid-April, through to mid-September, and we got some updated numbers today on all of this. Actually, Victoria had barely recovered, but the other states have recovered very strongly, and that just shows that you can achieve a recovery through the fiscal support. In the case of WA, SA, Queensland, only behind about 2 or 3%, actually 1 or 2% behind pre-pandemic levels. But for Australia, about a 9% hit to jobs, about a 4.5% hit, so half of that job loss has been recovered through to mid-September, and then a further recovery with the data out today. So, look, I think the main numbers to keep an eye on just over the next few months to track how this is all going, firstly will be new COVID infection numbers, just to make sure we're avoiding further outbreaks, and obviously the situation in Adelaide is a good case in point, although I gather there were no fresh increases to that number today. Certainly we need to avoid that occurring in any of the major capital cities, and it's most unlikely you'll get that in regional Australia. But the other key number to follow will simply be employment. And I think that will be more important than the unemployment rate, because we're seeing some really interesting changes in participation rates. So what we actually saw in today's jobs data was that whereas we had 13 million Australians with a job at the start of the year, that fell to 12.1 million, we're actually now back to 12.8 million nationally. So that's over 3/4 of the job losses that have been recovered. And even though the unemployment rate went up to 7%, I think the unemployment rate itself is sort of lagging the recovery, which actually kicked off 6 months ago. Look, one of the reasons that Australia's been less impacted than most countries overseas has been the success of the fiscal support packages, as well as the 6 cuts from the Reserve Bank that we've seen in the last year and a half. And I think this chart shows that success quite well. If you strip out Victoria, which sadly is where I'm broadcasting from, luckily we're just about reopened. But for the rest of Australia, actually retail activity is about 10% higher than a year ago. And interesting to see where that retail spending is occurring. It's not happening in services, but it is happening in spending more on food, less on cafes and restaurants, spending a lot more on household goods, maybe doing up the home office, but less on clothing and footwear. Spending a lot more online and through sort of click and collect models, and far less in crowded shopping malls and department stores. So it's a very different world we're in, and that's got its challenges, I think, for the central business district and for commercial property, which I'll come back to. But look, it's really all about mobility. The key to getting the economy back on track and businesses employing is for everywhere to be mobile. And so that's why it's so important to reopen the borders and keep them open. And you can see some data there around mobility and how that has varied by capital cities, much more mobile through regional Australia. And so, look, it's been a really challenging period for business and consumer confidence. I mentioned earlier, will it be a V-shaped recovery or a W? I think you can see that W shape coming through with consumer confidence and business confidence. And the low point, again, was 6 months ago. We tried to recover, then got a second wave in Victoria. But actually, with the latest read on consumer confidence, it's back up to a 3.5-year high, would you believe? And for business confidence, back up to an 18-month high. So that does show, I think, the success of the fiscal stimulus. As I said before, though, it's complicated because you had the shutdown, then reopening to COVID safe. The next step after that's going to be going to the post-pandemic economy. And until we get there with the vaccine, things will be uneven, and it's really going to be challenging for businesses to adapt to this change in behaviour, the CBD being less popular, more people working from home. Maybe we'll go back to sort of working from home 2 days a week and into the office 3 days a week. Who knows? I think some of the tech companies are trying to keep it all at home. So we'll see how well the CBD bounces back. But I think it is a question for businesses. How well have businesses adapted to not just technology disruptors, but demographic change and consumer preferences? Okay, let me move on before I get to some conclusions to property. And the Australian property market is one that everyone's got an opinion on, and most of us have got an interest in, either trying to get on board or maybe our children are trying to get on board with it all. But look, the trends have been really interesting to track. And you might recall back in April here and overseas, there were lots of predictions of collapses in property markets, and it just hasn't happened. Here in Australia, I must admit, when I heard of predictions of 20 to 30% falls, I was fairly, I won't say cynical, but I was very hopeful that that wouldn't occur. And our call has been for a 7% peak to trough fall for Sydney and Melbourne, and for smaller declines for other capital cities, and for actually increases in property values for regional Australia. And that's actually how it's panned out. Through the pandemic, the Melbourne property market's off about 5%, Sydney's probably off 3.5%. And then you look at the other capitals, they're actually moving higher. The Darwin markets and Perth market's a bit different due to what's happening with mining, although that's really starting to look up as well. So look, I wanted to reference some of this CoreLogic data, which you can see from their website. It's worth having a good look at their website, but it's right up to date. So this is from October numbers, and you can see that the only place that didn't go forward in October was Melbourne, which was down 0.2, but nationally, capital cities are up 0.2% and regionals are up 0.9%. And it's a similar trend here with over the last quarter, strong gains for regional Australia. And I do think that that trend is likely to continue. You know, we've sort of had to prove up whether or not we could work from home across a whole range of industries. and it was probably something that we were never going to trial unless we were forced to like this. And guess what? The technology's worked. So I think that what that's proven to businesses is that employees can live where they want to. They don't have to live near crowded capital cities or CBDs. And also for businesses, they can set up in more affordable fringe areas or even in regional Australia. And I think that demographic change and that flight from more densely populated areas and from high rise to more sparsely populated areas will continue. The other observations I'd make about the property market are firstly that actually the owner-occupier side, as the orange part of this chart shows, is going gangbusters. And we're certainly seeing that through our network. But it's the investor side that is very subdued. And I think that does make sense given the elevated unemployment rate, even though I think it's already hit its peak, and also just given the uncertainty for the economy for next year, albeit that I'm cautiously optimistic that that will improve. So look, that's the housing market. Commercial property is a bit tougher, there's a breakup state by state, and you can see in gold there, Queensland, what a recovery their markets had. Very strong through New South Wales and SA, a bit quieter in WA, and the Victorian market has been held back by the second wave, but that should all be opening up from here. So some fairly positive comments there on residential property. Just before I get to the markets, I think commercial property is really complicated because it depends on whether or not that's in the CBD or in fringe suburbia or in rural locations. And I think there are wide variations, CBD accommodation, for example, in hotels versus industrial commercial properties holding up really well. And also, I do expect a strong recovery when we get to that post-pandemic economy. So let me move on to the markets. And will it be a V-shaped recovery or W or K-shape? We've certainly seen examples of the K-shape with some businesses booming, but others at the same time really struggling to get through all of this. Certainly for the Aussie dollar, it's been a V-shape. If you told me at the start of the year, the Aussie would have got back to 72, 73, 74 cents by September, I don't think I would have concluded that we're about to have a global recession, the likes of which we haven't seen for 100 years, but that's what happened. I think this V-shape, when the Aussie dollar briefly got into the 55s, didn't quite get down to 55, but close, that ends the 10-year downtrend from $1.10 10 years ago down to 55 cents, so it's halved. And now we're expecting it to move a bit higher in the next couple of years, mainly driven by a weaker US dollar, partly due to the new administration who are going to be spending a lot, and also partly due to some of those COVID relativities. But look, if the Aussie gets back to say 75, 76 cents next year, I don't think there's any great damage there. And often we think about that when we're thinking about tourism. Well, that's not going to be an issue for the next year, you'd think, because we'll be spending our money locally rather than overseas. But just with that V-shape, it's also been a V-shaped recovery for the stock market, which looked very challenged back in March, the shortest bear market in history. Our market lost 39% of its value in 4 weeks, just extraordinary. But we've now recovered a lot of those losses. The Australian index is back to 6,500, and I think I'm getting more comfortable to suggest that that was the bear market. We'll now grind our way higher from here. But, the thing with stock markets is you need to be in them for long periods of time and get through these cycles. I was interested to read the other day that I think it's 1 in 8 Australians rated their superannuation because they needed to get through all of this. That's a lot of people that are going to be playing catch up with superannuation. So I hope they do, reinvest there. That's the thing about super. You've got to be in it for decades. But look, why is the stock market bouncing back? Partly because of the better news around a vaccine, partly because there's a view that the new Biden administration will see better global stability and less aggression, shall I say, and also because of just how low interest rates are. And in the case of Australia, we're down at 0.1. We won't be going any lower than that. Good to hear that the Reserve Bank don't want to go to negative interest rates. But, Europe and Japan have had negative interest rates for years now. Some other countries are toying with the idea. New Zealand and the UK have talked about it. But I suspect that actually this is the low in the cycle. And when we think about fixed rates being as low as they are through quantitative easing, through all the Reserve Bank bond buying, for mine, it seems like a really good place to lock in rates and take advantage of the just how low they are. Not so good if you're on the other side of the ledger, obviously, and an investor, really tough. But that's one of the reasons that investors have been encouraged into the stock market. And again, just on this K-shaped recovery, I think we were seeing that playing out with tech stocks versus the old school blue chips. But I do think now we'll go back to sort of convergence with all of that once we get to the post-pandemic economy, the other side of a viable vaccine. And it's going to be comforting when we go back to a more normal world and not this weird world where some parts of the economy are positively booming and others are really struggling to stay afloat. So, look, that's the financial markets. The last piece of good news I wanted to talk about is the government's fiscal support and the fact that we could afford this in Australia as a AAA rated country, and the cost of that debt is so low. And there is a difference there with other parts of the world, including Europe, where, and I know Europe has negative interest rates, but the cost of bonds does vary country versus country. In the case of Australia, 11% deficit. I never thought I'd hear the day where a Conservative government would do that, but it was absolutely the right call. So, over $200 billion worth of spending via that budget, close to $500 billion worth of spending if you add it all up. But that's what the economy needed. A couple of points to make there. Yes, it was a Team Australia moment and everyone stepped up to the plate. Even with all this extra debt, though, in the case of Australia, we'll be going to around about $1 trillion worth of debt. Doesn't sound too bad if you say it quickly. That will be about a 50% debt to GDP ratio. And if you consider how much higher that is in many parts of Europe, that's actually quite a workable ratio to service that debt. And Australia should maintain its AAA credit rating even with that level. The Reserve Bank look a bit more nervous about all of that, and that's why they cut rates earlier this month, because they're worried about the unemployment rate staying too high. But they also pointed out that when the government can borrow 10 years at 0.75%, it's a great time to take on board all this extra debt. And as it happens, the interest bill on this, so the amount of interest that the government is paying on this huge increase in debt, is actually going down because interest rates are so low. So as a percentage of GDP, the government are going to be paying less interest than we've been doing over the last few years, and a lot less than back in the 90s when we were getting through the 91 recession. So I hope that appeases any concerns that you might have around government debt. It's a lot tougher in Europe because those debt levels were already higher going into this. At least the ECB have said that they want to do whatever it takes. So look, that's maybe a discussion for another day, this whole thing of modern monetary theory and debt monetisation. Let me just finish off with a couple of predictions. Let me come back to this chart. But my predictions are, firstly, that I think Asia and Oceania will outperform Europe and the Americas in the years ahead. I think that's really comes back to how COVID has been managed. Secondly, I think it's going to be less about trade wars and more about technology under a Biden administration. So we'll see how that all goes. As I say, he doesn't get the keys to the White House till January the 20th, but I think that's what's going to be coming. And I do think we'll see a pivot on climate where the US will be rejoining its Paris commitments and being carbon neutral by 2050. And that will force the hand of other countries, including Australia. Donald was never quite as worried about the climate, a bit more worried about his handicap. In terms of the national economy, I think for some of the reasons I've outlined, the Aussie dollar is going to move a little bit higher. I think the euro will also be appreciating against the US dollar, and so therefore the Aussie euro cross rate should be relatively stable. Government debt here and everywhere is moving higher. In the case of Australia, I think it's heading to about 50%. But I'm pretty confident we'll keep at the AAA credit rating. I do think the Reserve Bank have reached their low. They've said that they'll stay at this level for 3 years. I think it might only be 2 years. That's how hopeful I am about what the world looks like in 2 years' time. So we'll see if that prediction is right or not. And in terms of GDP, we had a 7.25% contraction in Australian GDP for the first half of the year. I think you'll see that recover about 3 to 3.5% in the second half of the year that we're in now, and then another 3 to 5% next year, depending on the timing of the vaccine. That's the big swing factor. And on a state-by-state basis for Australia, look, Victoria will be lagging, but it's very much COVID dependent. And in all states and territories, I think there'll be a reasonable recovery next year and a really strong recovery in 2022. I've talked about property. I think we actually have had the dip for property, but Melbourne's probably the area that's most exposed. So perhaps it'll be the slowest to recover. But it's all going to be about reopening borders, keeping them open, and the states that can do that will see not just a rebound in tourism, but also in trade and also in jobs. So diagrammatically, that's where we are now. We've had the 7.25% decline. We're on our way back. Will it be upside or downside? I actually think it'll be upside in a post-pandemic economy, but it's going to be really tricky and uneven just in this COVID-safe economy we're in ahead of a vaccine. So look, that's the outlook. I've got my friendly disclaimer just in case that's a bit overconfident, but maybe my closing thought is recessions are always very painful. This one's been the most painful one in 100 years. But history says that the recoveries are more strong than the downturns. So let's hope that remains the case again. So look, thanks again for the opportunity to share those thoughts. I'll stop sharing my screen. And Paul, I'll be guided by you with respect to questions and other discussion. Thank you.
Thank you, David, for that thorough presentation. Congratulations on that, and we'll keep you to your predictions and see hopefully next year whether we give you an A, B or a C plus. Generally it's in the A and B category. We've got a couple of questions here, David. One sent by Arthur, and Arthur writes, are low interest rates fueling the asset bubbles that we see here in Australia?
Yeah, I think that's a very valid point, and I think that will be a concern for 2023, 2024, so 3 or 4 years down the track. And, in Australia, we've got used to avoiding the ups and downs because we didn't have a recession in between 1991 and 2020. And most advanced economies have upswings and then contractions around about every 7 years or so. I suspect that this ultra low interest rate approach the Reserve Bank has undertaken, and I don't think they had a choice. I think it will increase the frequency of these swings, including asset bubbles. So look, I'm not going to call a property bubble just yet. I suspect that's maybe 4 years down the track. And keep in mind, it was only a couple of months ago we were worried that property prices were going to fall too far. So, one step at a time. But yes, I do think that we need to be very careful about overpricing assets based on interest rates being so low. And maybe that sort of bubble might be more evident in stock markets than in property markets, because if you think about how we value stocks, we discount them by what's called the risk-free rate. At the moment, the risk-free rate is pretty close to zero. At some stage, inflation will come back. Reserve Bank will have to put back rates back up. And when that happens, then that discount will be vastly adjusted. So maybe the next bubble is going to be in the stock market, not in property markets. Again, hopefully that's 4 or 5 years away.
Thanks, David. We've got one here sent by Petros. Petros congratulates you, David, on that wonderful presentation. He asks, it's a question around quantitative easing, and he asks for an explanation of why the RBA recently announced 100 billion in quantitative easing, money which will be used to buy government bonds. Now, he asked for confirmation or some type of explanation that it's the banks and the financial sector that receives this quantitative easing amount at 1% interest and then buys government bonds that deliver 6% interest. Currently, we have record low interest rates, writes Petros, of 0.1%. Why would the Australian taxpayer fork out 6% interest on government bonds in this low interest environment?
Okay, it's a very valid question. I'm going to disagree with the 6% part of the case that was made, but I'm happy to. We're not going to agree on everything, but my take on it is as follows. Yes, the Reserve Bank committed to $100 billion worth of buying bonds over the next 6 months, and the main reason they've done that through which is quantitative easing, bond buying. The main reason they've done that is to compete with other countries overseas who are also undertaking bond buying. And if we weren't doing that, then the Australian dollar would move too high on a relative basis. So one of the reasons the Reserve Bank have committed to this is to help keep the Aussie dollar at a manageable level and for it not to move higher. The second thing that the bond buying does is it does add money supply. And so it is increasing the Reserve Bank's balance sheet. And at the margin, this extra money supply, it does flow through to liquidity in the system. Again, that's got implications for the exchange rate. But if we think about the rates that we were just talking about then, so let's think about the government issuing 10-year bonds at let's call it 1%. It might be 0.75%, but let's call it 1%. Now, the Reserve Bank don't buy them straight away. They get bought by investors. But in the secondary market, as part of quantitative easing, the Reserve Bank will come and buy these bonds from the investors. And there might be a small margin on that, but it's not 1 versus 6%. It might be 0.75% versus 1%. So the initial investor, be that a fund manager or an overseas investor or whoever it was, they might make 0.25%. And the bonds might sit on the Reserve Bank's balance sheet at 0.75%, but it's not as big a differential as I believe was asserted. Some of those bonds are state government rather than federal, so they might have a bit more of a yield on them. But again, it's quite a fine margin, the difference there. And to my earlier point, I think the cost of all of this simply lies in government debt. I don't think the taxpayer's paying for this. I don't think the financial system is paying for it. I think simply the federal government owes more money than it used to. And with the charts, I tried to explain why the interest cost of that is actually stable to coming down. So I think it's a sensible time for that to happen. So I'll push back on the thought that this is a cost to the taxpayer. I do understand that ultimately the bonds need to be repaid, and ultimately it might be through corporate profits or personal tax that you generate revenue that ultimately pays back the debt, but it's at cheap levels. So I'm actually not concerned by that process. And the main point I'd make is we need to compete internationally because everyone else is doing it. And if we didn't, then the Aussie dollar would go through the roof, and that would be difficult.
Thank you, David. We've got a question here, and I'll just move up because I've just received a new question around the US election and the likelihood of President-elect Biden implementing a lockdown strategy across the US post-January, of course, and the ripple effect to the economy and the rest of the world. And we thank Nick for asking that question. Yeah, that's a great question again. And I think that's quite a likely outcome, again, after January the 20th. I don't think that's going to happen prior. And again, this is all going through the courts now, but the markets are basically pricing in that Biden will definitely be in the House. What also happened, though, was that the Democrats didn't win the Senate. And so what that means is some of the things that the Biden administration wanted to do simply won't happen, or they will happen more slowly. And some of that might be around renewable energy and some of the fiscal stimulus packages. But yes, I think with COVID-19, there will be more aggressive lockdowns after January the 20th.
and we've proven here in Melbourne that that's the way you win this war. And that's going to be difficult for the US economy. And that goes to my earlier point that I think that European economies and the US economy will not be as strong as most Asian economies because of that overhang and the second, third waves and what they mean for lockdowns. So yeah, I think that's coming. But having said all of that, the vaccine news has been pretty encouraging, and I'm getting more confident by the day that, that's only 6 months away, not years away. And 2 months ago, there were people saying, there might not be a vaccine at all. And that seems to be wrong now. The epidemiologists seem very confident that we'll get one. And so maybe that's the answer to the challenges that the US and Europe have with respect to lockdowns.
Thank you, David. I'll paraphrase a question that's been asked by two guests today, Tom and Vince. And if put together, the question would run something like this: if immigration returns to pre-COVID levels and low rates, do you think there's a chance that rates will increase to diffuse a housing bubble?
So, as in immigration rates will increase?
Yes. If immigration if immigration returns to pre-COVID levels,
yep.
Do you think there's a chance that rates will increase to diffuse a housing bubble, hence immigration linked to housing bubbles?
Yes, okay. And so I think that's quite likely. If we look at population growth in Australia, it's been running between about 1.5% and 2% for over a decade now. It's definitely going to be close to zero this year. It might be 0.2% from natural population growth, certainly no net migration. Next year, it'll be slow but recovering. In 3 years' time, I suspect we'll be back closer to 1.5% population growth, and that will be healthy. I hope a lot of that population growth is in regional Australia, not just in crowded capital cities, but that's another discussion point. And yes, I think that will be part of the recovery, and that will be a reason why at some stage the Reserve Bank will need to put up interest rates. And I think that's at the heart of the question, is that is the solution to diffusing or mitigating the risk of a housing bubble. So yes, I think that's that crystal ball aligns to mine. And I think there's been some criticism in the past that our economy is too reliant on population growth, but I think a 1.5% population growth rate is quite a reasonable aspiration, and it has positive benefits for filling skills gaps and improving diversity, and that's the number we should be looking for. But I would like to see a lot of that population growth in the regions, not just in Melbourne and Sydney.
Thank you, David. A question now sent by George about renewable energy. And if I was to paraphrase this, your views on Ross Garnaut's blueprint to set us on a path of 100% renewable energy. Do you think government policy is aligned well with this thinking, i.e. business incentives?
Yep, another really good question. And I've been reading Garnaut's book. It's a great book, but it takes time to read. I need to read every page about 5 times to take it all in. And look, he makes the point that there's such a great opportunity for Australia to lead on innovation around energy and around renewables, and that to get that right will be good for our economy. It'll create jobs, it'll make us more competitive. And so do we have the right policies for that? Well, you'd have to argue that federally we haven't had the right policies for a long time. It's ironic that Howard and Rudd both agreed on an emission trading scheme in 2007, but it never got off the ground. And I won't cover the history as to why that happened, but that's what happened. So, economists, scientists, businesses all agree that an emissions trading scheme would be the most effective way of doing all this, but it's just not going to happen, is it? So we're stuck with these sort of patchwork policies. I actually think business will take the lead on all of this and will embrace technology. You think about the US going to carbon neutral by 2050 and Japan the same. So it might not matter as much what federal government policy is. Businesses have to adapt to that because that's going to be the trade environment. So I'm pretty optimistic that ultimately innovation and technology will get on the right side of this. You look at hydrogen fuel, hydrogen energy, it's such a fantastic opportunity. But, you know, there's still work to be done around how workable that is, including through storage and batteries. So there needs to be innovation to make that all work. But I have no doubt at all that that will come. We will solve those issues. So, yeah, I think my short answer is no, I'm not convinced we do have the right federal policies, but they're sort of bumbling their way through and doing a bit of a patchwork. But I think industry will take the lead on this, and we will achieve those outcomes irrespective of government policy.
Thank you, David. Now, we are getting very close to 8 o'clock. We'll take a couple more questions if we can. And one of them, I was always expecting this question, and it's a question to do with Australian-Chinese relationships and what is your forecast in these relations? And I suppose if I can add something to this, David, what are its trade implications of that particular relations? We have seen in the press, and those that have been reading the financial press, there has been issues with Australian products at various Chinese ports not being able to get the products out, and there's an ever growing list of products out there. Just your general thoughts on the Australian-China relation.
Well, it's challenging, and it's really disappointing that, you know, there you've got US and China in a trade war because the US wanted one. It's not as though Australia wanted a trade war with China, but we've sort of got one. And obviously there are political overtones with this, and it was in the news again today. If you'd asked me a month ago, I would have said, oh, well, it's difficult, but at least the tariffs have only been applied to a small range of goods, and at least our trade volumes with China are holding up really well, which they are for goods, not for services, and that hopefully we can resolve this politically, diplomatically, and we can reinforce with our friends in China that a trade relationship is mutually beneficial. I have to say, though, having seen the reports over the last couple of days, and, you know, good to see Australia seeking diversification and speaking to other trade partners, whether or not that's Japan or Indonesia or India or wherever else. But we seem to be going a little bit harder on really refuting the claim from China that we seem to be a little more aggressive with our language, don't we? And it just half makes me wonder if it's going to get worse, and therefore it's really all going to be around diversification. And to the extent that exporters had a nice deep market there in China, I've got a feeling that market will be less accessible, and we're going to need to diversify to other locations. I suppose the other part of that though is China doesn't have an alternative for iron ore. Well, they've got Brazil, but Brazil has been brought to its knees, their economy, because of COVID-19 as well. So the big ticket item, iron ore, and maybe to a lesser extent LNG and coal, we're the only place they've got to get a lot of that. So those numbers will still probably hold up pretty well. But look, it's regrettable. It's very regrettable. And as I think I've said before, I'm sure exporters have been thinking for quite some time, well, how do we diversify? We've got too much of a concentration risk with China, and all of this is up the ante there. So the need to diversify is even more urgent. I hope there's a diplomatic solution, but I must admit I'm getting more pessimistic on that front.
Thank you, David. And before we make some final out remarks, just a final question from me, if I can be indulgent to ask you a question direct. We hear about negative interest rates, something we haven't seen here in Australia. Once upon a time, it was just a theoretical exercise. If you wanted a few extra marks in your economic essay, you mentioned that scenario could exist. Do you think that we'll see them here in Australia, both on retail side of things and also the wholesale side of deposits?
Yeah, again, it's a good question, Paul. The quick answer is no, I don't think it's going to happen. The Reserve Bank have been very clear, and in their latest messaging, they said that if they need to do more to help the economy, that they'll do it by more bond buying, and they'll just extend quantitative easing. I certainly don't have any great evidence that negative interest rates have worked terribly well in Europe or Japan, and so I'm glad that we're not heading that way. Look, there are a lot of bonds trading around the world that mainly apply for big fund managers who've got billions of dollars to invest and need to invest some of them in AAA rated bonds. There are a lot of them floating around with a negative yield. So that could happen, but I think far more likely the cash rate will stay at 0.1, the 3-year target will stay at 0.1, the 10-year bond rate with the government, it might come down a bit, but I don't think it'll go negative. And so I don't think either. It certainly won't impact retail part of the world, but even the institutional part of the world, I don't expect negative interest rates in Australia.
Thank you, David, for your presentation and your wonderful answers to all those questions. Well, thanks everyone for joining us this evening. It's been a pleasure to have you here with us. Thanks to David again for your wonderful presentation, and of course to the Greek Community of Melbourne for putting on such a great lecture series. We look forward to seeing you at our next joint event. Have a nice night.
Thank you.